This is a very hot topic. In fact, the book Gatsby just put out a new pronouncement on pension, Statement 67 and 68, which changes some of the things that are presented. But we'll stick with what's in the book because it's going to take a few years for governments to transition to the new standards. Okay? What has happened is, and you've heard of Detroit, right?
Yes.
What's happening there, and in many places around the country. We have severely underfunded pension plans. And this amounts to billions and billions of dollars, and nobody knows what's going to happen. So this is what happens. You started at the age of 22 with state government. You've decided you really like it, and you work for 30 years. Okay? Let's make it 33 years. I want you to reach 55, okay? So you've worked for 33 years, and now you say, you know what? I've worked a lot. I want to do something. I want to retire. What happened was every paycheck you got, there was a deduction of 5%. I'm just giving you a number, 5% from your paycheck for pension. And the employer, which is in this case the state of New Jersey, Miss, could you just, okay. The employer, which in this case is the state of New Jersey, is also putting money in, right? And together, what's the purpose? That in 33 years, there will be enough money to get you a retirement check every month. That's the way it works. And it's really no rocket science, because what has happened is we have, actuaries, right? These are the people who tell you how long you're going to live, right? So actuaries have these tables which say, well, a male is expected to live for this long and a female is expected to live this long. And when they come together, they put together calculation which says, and I want you to now just visualize this in your head. So he's retiring at 55. He's expected to live to the ripe old age of 90. Okay? So basically, he's expected to collect his pension for another 35 years or so, right? He's going to get a pension check every month. So now, you know nothing about pension. What do? You calculate 33 years from now what the present value of his pension payments are going to be over his life. You come up with that number, right? And let's say it comes up to be $2.5 million. You need to do what? Get $2.5 million so that at the age of 55, you will have most of that $2.5 million because you'll still be earning interest. So this is the actuarial process. You're calculating, what are you doing? You are taking into account his contribution and the state's contribution, right? Such that at the end of the period, you'll have money to pay him. Slight problem. He put his money in. The state doesn't. What happens? We've got a problem. All of a sudden you read things in the Star Ledger. State employees getting, big pensions. They shouldn't be deserving of that. Well, did somebody ask the question, did the state put in the money? And you say, but wait a minute, if he's putting the money in, isn't the state required to? Yes, they are required to, but Gatsby does not enforce the state into putting money. They don't deal with funding, they deal with financial reporting. It's the credit rating agencies who look at that. And this is what's happened in New Jersey and many states. And I'm telling you this because the terms we're going to be using are all going to be talking about these. There are these fancy terms, and you look at it and say, my gosh, what does this all mean? This is what it means. And we'll talk about these different terms. So for instance, you'll hear the word net pension obligation. What is it? It's not a fancy thing. What it is if I'm required to put $10 million for my employee and I only put $5 million, what's my net pension obligation? The other $5 million, right? And if I do that continuously, what happens to my net pension obligation? Keeps on going up. And if I don't put the money, what am I also losing? Investment income. So now I have what? Interest on net pension obligation. And it just keeps on rolling and rolling. And what we have now is this real problem in this country where we have severely underfunded pensions and people don't know what to do. Let me give you two interesting stories. One from New Jersey and one from the great state of Texas. Besides pension, when he retires at 55, the government has promised him that not only will we give you a pension check every month, he says, what's my pension check going to be? So it's very simple. Every year you work, 2% of your salary. So he says, okay, so I worked 33 years. 33 times 2, 66% of my final paycheck. Is that what I'm going to get? Say, yes, that's what you're going to get. 2% for every year. Now in New Jersey, it's slightly less than 2%. It's number divided by 55. Okay, so it's actually, slightly less. But I'm just giving you an example, 2%. So he now knows he's going to get 66% of his salary. By the way, that's called a defined benefit plan because that's what he's going to get. He doesn't care how New Jersey invests. I mean, he cares. He just wants his 66% of his paycheck. And you say, which paycheck? The last one or the first one or the one in the middle? The state comes back and says, no, it's very simple. We take your 3 highest year salaries. So we find out when you made the most money over 3 years. And we average it, and we take 66% of that. Okay? So most people make the most at the end of their term. Yeah, Aaron?
Aren't they trying to get rid of this system?
Well, they are now changing to defined contribution plan, which we'll get into. Yes. Yeah. To take them from defined benefit to defined contribution. Now, think about you are the state treasurer. What are the risks that you have? One, the big question is, all these people giving you money to invest, you need to figure out what your investment return is going to be. Because it's all based on what you're going to earn on this money. What if I came and told you that a state assumed that they were going to earn 8% forever? What would your reaction be? You'd say, are you nuts? As you look through the CAFRs, you'll see that the returns, they're crazy. What happens if you don't make the 8%? Well, then you are under, because it's based on earning that, right? So that's pension. Now let's go to the health benefits. So at 55, he's not ready for Social Security yet. He still has to wait till, I'm sorry, you probably have to wait till 70 at this rate. But let's assume at 7, so he's got 15 years. He's got to figure out how he's going to pay for health benefits if he retires. So the government that he works for says to him that, every month you and your spouse, we will cover them. It's going to cost them, right? So shouldn't they be putting money aside for that? None of them does this. So Gatsby came out with a pronouncement, Statement 43 or 45, which says, you know what, you can't ignore this. It's a future liability, you have to show it. Just like you do pensions. People got really upset because with the pension, at least people were putting money aside. With health benefits, they didn't even want to think about it. They said, 33 years from now when he's ready to retire, they'll take care of him then. We don't worry about it now. It's too far away. Gatsby said, you have to do this. Now I'll tell you the story of the state of Texas. State of Texas did this calculation of the funding, underfunding, and they saw billions and billions and billions of dollars. The state legislature said, this is crazy. these people up north, they're going berserk. We got to do something about this. They passed a law. And the law was, you cannot follow GASB. You cannot follow GASB guidelines. So the towns and the authorities went to their auditor and said, would you please give us a clean opinion? The auditor said, forget it. You don't follow GASB, no gap, no clean opinion. So they went back to the legislature and said, what do we do now? They said, well, we'll make it optional. If you want to follow it, you can. If you don't want to follow it. And right now, I think there are only 2 towns in Texas which have chosen not to follow GASB rules. So that's the example from Texas, right? Now an example from New Jersey. Many years ago, and I won't say any names or anything like that. Many years ago, the state was having a little problem with underfunding its pension. And there was a young MBA, PA graduate from Rutgers, this is made up by the way, who worked at the treasurer's office and said, I have a brilliant idea. The stock market was taken off, was like 10, 12% return. They said, I've got a great idea. What we're going to do is we're going to borrow billions of dollars, invest it in the stock market, and make more money than the interest that we're paying. IRS came knocking on the door, said, that sounds like arbitrage. You can't make money. They said, okay, don't worry. What we'll do is we'll make these taxable bonds. So we don't have to worry about arbitrage. Even though the state of New Jersey is issuing the bonds, we'll make them taxable. So IRS is out of the picture. So they go ahead and issue the bonds at 7.65% interest. And they said, we got a money-making machine. Take that and put it in the stock market. For the next 2 years, they made 18 to 19% interest on that 7.65. The guy who probably came up with this was probably got Employee of the Year award. You know, he probably got accolades, but then something happened. The market turned around. And it fell, and it fell, and it fell. And what happens when it goes below 7.65? You begin to now have negative arbitrage, right? And these are long-term bonds. What do? What they just did was dig a hole for themselves. Just think about, and I'm giving you this because these are the types of decisions that are made. And unfortunately, you know, it doesn't take someone with a lot of common sense to figure this out. And you know, and we won't go into this, but there's an area within the text, I don't know if it's in this text or not, where there are derivative contracts. You probably learned a little bit about derivative contracts, where many states have entered into derivative contracts, which is to protect the rates from going up for them on floating rate bonds. But you know, there's one thing to do things for insurance purposes, but another to be speculative. But that action alone dug the state into what? A bigger hole. So with that, we'll start off now with the pension trust funds.